Hello all. Welcome to the last video of chapter 6, module 6. So we've been talking about business income. In this video, we're going to focus on restricted farm losses. We should be able to get through it pretty quick. So once it's done, I have a couple other slides to go through, but then that'll be the end of the chapter. So let's get right into it. Um, So generally, business losses can be applied against any sort of income. So if I have employment income, I have a day job, and I want to run a business. In the early days of a business, it's very common for the business to lose money while we wait for it to grow, but I'm spending money on an income earning process. So when we calculate our net income in chapter 1, we could include our employment income, but then at the end of that process, we can subtract from the income any business losses that we've incurred. Why does this pertain to farm losses? Well, high income individuals will often have large houses on a large piece of land. So there was kind of this expectation, not an expectation, but there were individuals who were partaking in farming, but there was no real intention to have the farming activities be profitable. What they were doing is they were having a modest farming activity on their large piece of land, but were really using it as an avenue to generate losses to apply against their very high salaries. So they had this, I guess you could say it was kind of a hobby farm, but they were using the losses to apply against, someone who makes $500,000 a year and is in the highest tax bracket. Applying those losses can provide a significant tax break. So the government came up with this idea, goes, if it's a legitimate farm, we can't deny the losses. If it's a hobby farm, there's no source of income, so we're not going to allow those losses. We're not going to allow the losses. So if you are a full-time farmer, it's recognized this is your business. It will be treated as such. If it's a hobby farm, it will be denied. But what about someone who's starting farming, but it's not generating enough income for their expenses, but they want to be profitable eventually? So they came up with these rules for a part-time farmer. So full-time farmer is straightforward. If you are farming full-time, your business loss is fully deductible. If you are a hobby farmer, meaning you just kind of do it you do it as a hobby, as a pastime, you're not really expecting to make income. There's no source of income, therefore no business exists. No losses are deductible. All nothing. Part-time farmers where it gets complicated because they allow some of the losses to be deductible. The rest of the losses will be restricted, meaning you won't be able to claim those losses until you earn farming income. So it recognizes the farm losses, but can't apply those losses until you demonstrate that profit is your motive. And you demonstrate that by earning profit. Part-time farmers are involved in a farming business, but that business is not their main source of income, so the losses are going to be restricted. Income Tax Act 31 splits farm losses into two pieces: the restricted, down here, restricted farm losses, and the unrestricted farm loss. The first $2,500 of farm losses, it's relatively a small amount, so you can deduct that fully. So that's unrestricted. The next $30,000 of loss you incur, half of it is unrestricted. So farm loss between 2,500 and 32,500. So that's a $30,000 difference. 50% of farm loss is allowed or unrestricted above that 2,500. So if you have losses of 32,500, you've maximized your unrestricted farm loss, and that maximum is 17,500. This $30,000 difference, half of that is 15,000. 15,000 plus the original 2,500 you get, add together to create a maximum of 17,500. Of that 30,000, half of that is restricted, means you cannot claim it until you have farming profits, and any losses above $32,500 are fully restricted. So difference between total farm loss and the unrestricted farm loss amounts are restricted, deductible in future against profits from same farm business. So if we have a farm loss of $1,800, that $1,800 is below our $2,500 first threshold. So up to $2,500, completely unrestricted. So that $1,800 can be applied against any of your other income. $1,800, no restricted amount. If the farm loss is $44,000, we are over that 32,500. So that means we've maximized our restricted loss, 17,500. We've maximized the unrestricted loss, and the restricted loss will be whatever the difference is, 44,000 minus the unrestricted portion. If we are between $2,500 and 32,500, then we have to figure out the unrestricted portion. So the unrestricted farm loss will be, so we'll do it like this. We have $21,000 is our loss. The first 2,500 is unrestricted. Of that amount above 2,500, half of the remaining is unrestricted. 9,250. So 9,250. Then we'll add back the 2,500 unrestricted we already applied, 11,750. So it's that original $2,500 of unrestricted farm loss plus half of the amount between 2,500 and 21,000. So half of 18,500 adds to our $2,500. The restricted farm loss will be $21,000 minus our unrestricted portion, 9,250. But notice 9,250 is 21,000 minus the unrestricted 2,500. 18,005 is what we're dealing with. Half of it is restricted, half of it is unrestricted. So if we do divided by 2, 9,250. So both the unrestricted and the restriction got that 99,250, and then we're just adding $2,500 to the unrestricted portion. So in the example 2, we've maximized it. In example 1, we didn't reach that $2,500 first threshold. And in example 3, we were in between. So for the exercise, Mrs. Suzanne Cote is a high school teacher. To help finance the annual family vacation, she's been growing zucchinis for sale on a little plot next to her house. Her investment in time and money has been small, but the growing conditions are ideal for zucchinis. Although she has no farming background, in most years she's made a small profit selling at the weekly farmers market. However, she incurred a loss in 2025 of $18,700 due to poor weather. How much of this loss is deductible in her 2025 income tax return? Calculate any restricted farm loss that will move forward. So we have our 18,700. That's how much our total loss. The first 2,500 is unrestricted. So we'll take that out. That's unrestricted. 16,200 remains. Divided by 2, another $8,100 will be unrestricted. But that also means that $8,100 will be restricted since we're splitting it in half. This unrestricted half goes with the 2,500. This restricted half sits here until she makes profit next year. So at 18,700, the first 2,500 is unrestricted plus half of the difference. We combine these amounts to be 10,600. So that's the deductible portion of her farm losses. This is the unrestricted farm loss. So she can take that 10,600 and she can deduct it against that employment income that she's been earning during the year. The $8,100 restricted farm loss carryover will sit, and it says that she earns a small profit at the farmers market each year. So if next year the weather improves and she has some farming income, some farming profit, she can then apply the $8,100 to that profit. I just have the maximum part-time calculation down here. So if the income's at the maximum 32,500, the unrestricted portion comes from these two calculations, and that hits our maximum of 17,500. And I think if we had that $44,000, yes, it still calculates up to our maximum, showing that 26.5 is restricted going forward. So there we go. That is the last exercise we're covering. That's restricted farm losses. There's just a couple of slides left I want to get through just to finish up the chapter. Professional income work in process. So work in process is amounts to be expected after year end. You get this very commonly in law firms and accounting firms, where someone's working on a file, but the year end has occurred. So we're not going to be actually billing that file until after our year end. In the past, the Tax Act allowed for unbilled WIP to be excluded from business income. We've earned it, but we haven't billed it yet. So it used to be you could leave it off your financial statements. But now the rules have been updated to treat that WIP as inventory. So as we're earning it, it doesn't go through our income statement, but we will register it on our inventory. I guess it does go through the income statement because we will treat the debit as inventory and the credit as revenue. So the value of the WIP will be valued at the lower of cost and fair market value. Include the WIP in business income. So even though we haven't billed the client yet, I've earned the income, so it will be included. Sale of a business. The problem we have with sale of a business is when a business comes to an end, there's no longer any source of income. So this results in unusual circumstances. Usually a source of income needs to exist in order to apply expenses. So Tax Act Section 23, sale of inventory after business ceases to exist. Any gain is fully included in business income. Any loss is treated as a fully deductible business loss. It could be argued that since the business has ended, this inventory is now of a capital nature and so should be treated as capital gains and losses. But that means it would only be included in income at 50%. So the CRA put in this tax rule to say, well, since the inventory was treated as business while the business was operating, it's going to maintain that status for the sale of the business. So when we sell off the inventory in a business exchange, we're still going to include it in business income as if we'd sold it as inventory. Income Tax Act 22, joint election by seller and purchaser for for sale of existing accounts receivable. The seller loss on accounts receivable is fully deductible as a business expense. The purchaser includes loss on accounts receivable as business income. So this is specifically pertaining to the uncollectible portion of accounts receivable. When we accrued the accounts receivable, it went into our revenue. So when we fail to collect it, that can deduct from revenue as an expense, a bad debt expense. But now at the sale of business, I'm selling my accounts receivable. So if there's a portion of this I think might not be collected, what do we do about it? So the election allows the seller, let's say the seller has receivables with a face value of $30,000, but they think they're only going to collect 25,000. Now the seller's already deducted a reserve of $3,000. 37,000 minus 3 is 27. So a reserve is already in place accounting for up to $27,000, but we think we're only going to be collecting 25. So when the vendor buys it, it only paid us 25,000. The vendor's only going to give us the money for what they think they're going to get back. So the seller, with or without election, that $3,000 reserve counts against our business income. That 30,000 was recorded to revenues originally, so our $3,000 reserve applies against that revenue, that business income. If we don't make the election, then that additional loss, that 30,000 of revenue minus our 25,000 of expected collection, is capital in nature. So we don't get to deduct the full amount. We can only deduct half. So without the election, we're only deducting $2,500. With the election, we can consider the full $5,000 as a business loss. So the seller wants to make the election. I've included $30,000 in my income. I want to be able to account for the $5,000 of lost revenue I won't collect. If we do the election, oh, sorry, let's start with the if we do the election, the purchaser will include the $5,000 in income. Since the seller has the $5,000 coming out as a business loss, the purchaser will add the $5,000 to their income. So what will happen is they will now be allowed to deduct any amount of that $30,000 that's actually bad debt. So after the sale, any difference between $30,000, the face value, and the amount actually collected is fully deductible as bad debt. Now they get back to this 30,000 because the vendor paid $25,000 for it. So I will pay 25, that's a credit to cash, and then I will also credit my business income the additional 5. So cash 25,000, business 5,000 of income, and then my debit is for the full $30,000 of accounts receivable. Since I'm adding $30,000 to my accounts receivable, if I truly only collect $25,000 of it, then the 5,000 I didn't collect will be deducted from income. That deduction, that bad debt's 5,000. So I include the $5,000 of income, bad debt $5,000, it nets to zero. So if I collect what I expect to collect, the net effect on my income is zero. If the purchaser does not do the election, they'll recognize the accounts receivable at the tax cost of $25,000, what they paid for it, for receivables which represent capital property. If they don't collect the 25,000, or if they actually collect more than 25,000, the difference will be treated as a capital gain. If they fail to collect the $25,000, let's say they only collect 23, that $2,000 of loss is going to be considered capital loss, so they'll only be able to deduct 1,000. So basically, if you do not do the election, that exchange of accounts receivable is treated as capital. If you do the election, that exchange is counted as business income and loss. So it determines whether or not it needs to be accounted for at 50% or 100%. And that is the end of chapter 6. If you have any questions, as always, feel free to send me an email. Otherwise, thank you for your time. I will see you in chapter 7, where we will discuss property income. Thank you.